this isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning. And there's just far more demand for physical silver than there is the availability. And the paper system is beginning to show great strains. People have accepted paper promises for a very long time. And I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals.
Silver prices have shattered all previous records, reaching an astounding $52.58 per ounce in London as of October 2025, a level never witnessed, not even during the Hunt brothers' infamous market corner attempt in 1980. This milestone isn't a sudden spike, but rather the culmination of 8 consecutive weeks of steady gains across the entire precious metal sector. Gold has also surged to new all-time highs, signaling that this rally extends far beyond one metal. According to Andy Schectman, what sets this movement apart from previous ones is that it's driven not by speculation, but by an actual physical shortage. London, now the epicenter of this unfolding crisis, is under immense delivery pressure, triggering what experts describe as a classic short squeeze, with a lack of available silver pushes prices to extreme levels. The shortage has created an unusual price disparity between markets, with London trading up to $3 higher per ounce than New York before stabilizing around $155 by mid-October. Such a gap is an unmistakable warning signal that investors are demanding real deliverable metal, not paper claims or leverage contracts. Throughout 2025, silver has skyrocketed nearly 70% in London, outpacing gold's 55% rise. Analysts suggest that this divergence marks a decisive shift away from fiat currencies and paper assets toward tangible forms of wealth that cannot be created by keystrokes. The physical scarcity of silver has reached a point where it's not just a commodity anymore. It's becoming a statement of financial sovereignty in a system increasingly built on debt and promises. Schectman believes this surge reflects a deepening mistrust in global financial institutions. With inflation fears mounting, geopolitical conflicts escalating, and confidence in fiat systems fading, investors are no longer merely trading silver, but taking delivery and securing it physically. This behavior represents a fundamental shift in market psychology. As Schectman warns, if this trend continues, it could break the paper-silver market entirely, forcing a long-overdue reckoning between the illusion of paper wealth and the reality of physical scarcity. Now we present the clips from Andy's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
I've never seen anything like this. This is the term that everyone keeps throwing around is the word backwardation. Backwardation is an environment that shows extreme delivery stress. It's unprecedented. This isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning. And there's just far more demand for physical silver than there is the availability. And the paper system is beginning to show great strains. People have accepted paper promises for a very long time. And I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals. But I think it's beginning to show that the paper promises that this whole Western system has been based upon is starting to break. London, they have a 140 million ounce float, yet they're trading 600 million ounces a day in contracts that technically are deliverable. What could possibly go wrong? There's over 2 billion ounces in paper claims out there on a float of 140 million ounces. So that's exactly what it is. It's a situation where the paper promises, this rehypothecation is being called on the mat. And you can see that. Look, for example, the lease rate in silver in London, when you lease silver in London, it would be something like you want to short a contract. You want to short the price of silver, but you don't have the metal. So you have to borrow metal through leasing it in order to deliver the metal, to drive down the price. Normally that lease rate is somewhere in the neighborhood of 0.5% or 1%. In October, it's jumped up over 39% to over 39%.
Wow.
And at the same time, we've seen silver rise since August, when the lease rate was at about 1% or so. up to $53 here. So you see the price rising, the lease rates rising. We're seeing the exact same thing in platinum, but it's a situation where right now you have the spot market trading well above the futures price. In other words, buyers are very desperate for immediate delivery. And it's very rare to see this, Adam, in
Yeah.
silver. It's very rare. It signals urgent demand, depleted inventories, and really it's a systemic shortage of deliverable bars. And that's all because of rehypothecation. In other words, it's getting called onto the carpet.
Okay, and where is this shortage really manifesting most? Is it in London?
Absolutely, it is. I mean, you're seeing delivery stress on that is exacerbating it on Comex. We've already seen 16.5 million ounces delivered in Comex, adding to the limited vault supplies. But yes, the main stress is in London right now, and much more so than on Comex. And really, it is, in my mind, the epicenter of where all of this could really get into some serious problems, where you're beginning to see margin calls for traders out there who are receiving a margin call because the price is going against their short position, and the lease rate and the borrowing costs are so high that they're not able to get the silver to cover their position. And that's when things begin to get very, very, very interesting. What it really tells us is that buyers aren't just rolling over their contracts like they used to. They're standing for delivery. They're demanding real metal. And these delivery numbers are well above normal. So I guess if you could encapsulate it easily, it's that the rush for gold and silver is real. It's intensifying. And markets just aren't trading paper contracts right now. The people want the real metal in hand. And in a world where paper contracts are vastly overstating the supply, the short term implication would be liquidations and survival driven selling can trigger volatility. That's the short term. Even sharp pullbacks. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate and silver sustains its higher prices, $50 plus. But long term, if confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100. And I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup 1980, the bottom of the cup the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another. It's a double cup and handle, but the way that it works is once silver has broken through 50, which it has, technical analysis would say you take the distance from the bottom of the top, which was $46, from 50 to 4, and you add it to the top. That would mean that the next target from a technical analysis standpoint is $96. And I think that's exactly what you will begin to see, where the market physically begins to exert itself over the paper shenanigans that we've seen for a long, long time. The United States for the last 40, 50 years has bet on a strategy of strong dollar and U.S. bonds and service jobs, where the rest of the world, in particular the BRICS and China, have, you know, have not been ignoring the factories like we have not been ignoring commodities like we have. China, as a good example, did the opposite. It built factories, accumulated commodities and gold, and now is really pushing away from relying upon the dollar. That is ultimately, I think, where we're going. Yes, exactly that, right there.
As global markets undergo a dramatic transformation, what's unfolding goes far beyond an ordinary metals rally. Silver's explosive rise has triggered profound changes within the financial system. Physical withdrawals from vaults are accelerating, futures contracts are becoming harder to roll over, and major institutional traders are increasingly demanding actual metal delivery instead of dollar settlements. According to Andy Schectman, the heart of this story comes down to one pivotal choice: metal over money. Both nations and investors are converting their currency reserves into tangible assets as silver and gold lease rates soar to levels that reveal deep structural stress. Even the largest Wall Street trading desks are quietly preparing for a future where paper claims lose credibility and only physical assets retain value. Meanwhile, Washington remains largely silent. Policies like the so-called Genius Act aren't true economic reforms, but rather mechanisms to inject liquidity, support the bond market, and allow the dollar to gradually devalue against real assets. Schectman argues this isn't accidental. It's a deliberate strategy to make U.S. manufacturing more competitive by reducing production costs globally. Beneath it all lies a quiet admission. The era of endless fiat expansion is nearing its end. The only question now is whether this carefully managed transition will restore balance or trigger a new wave of financial turbulence.
This is the dollar devaluation trade. This is exactly what I said on your show, where they're using the Genius Act and the stablecoin bill to not only to fund the treasury market, but think of the $3 trillion that's held up and holed up at the Federal Reserve, right? All of this money that's been created by the banks that they don't want to lend out into a fractured economy, so they leave it at the Fed. They're going to now pile all of that into treasuries, into the stablecoin bill, the Genius Act, and this is going to devalue the dollar. Keeping your wealth in dollars is the surest way to go broke. This is what they want to do to bring back manufacturing. That is the Mar-a-Lago Accord. They want to devalue the dollar against assets in order to make manufacturing more competitive. And you know, Judy Shelton was just on my show again. Actually, Michelle McCory did it this time. She runs our YouTube channel as well now. And last week she said it again, that Trump is going to peg the back end of the Treasury market on July 4th next year. It's a big day for him. It's the 250th anniversary. If they back the back end of the Treasury market with gold and let gold slowly, like Luke Groman says, let it go higher, 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 higher. And yeah, there'll be volatility, but it keeps going. And no one acknowledges it. Everyone says, oh, it's, you know, it's FOMO or it's going to crash. But what if it's part of a bigger plan? By letting gold go higher, you're not doing it to make my job easier. You're doing it to let the dollar devalue. Why would you want the dollar to value? Ask Stephen Mirren, the architect of the Mar-a-Lago Accord. To sell manufacturing. How do you sell manufacturing? You abandon the reserve status of the dollar. You don't give up on the United States, but you abandon the reserve status on the dollar by letting the dollar collapse. It's down 11% in value already this year and falling as gold is moving in the other direction. If you peg it to the back end of the bond market, and in Judy's book, she says 5, 10, 20, 30, and 50, with 30 and 50 having a very small coupon, very small. But if you do that, you can now bring back manufacturing at zero upfront borrowing costs and sell your product to the world at a massively devalued dollar. This is what they want to do. And so when you see gold and silver going higher, it's not gold and silver going higher. It is the dollar losing ground and losing value. And the big money understands this. The big money understands this inherently. And this is what they have been doing. The central banks understand this. This is why they have been taking positions in gold and silver the way that they have. I think this is just the very beginning. So, yes, you're going to see pullbacks. You will see volatility. Nothing goes straight up. But I would agree with you that ultimately it is a buying opportunity. And I try and say this without coming across as being a snake oil salesman. I don't care if people rush to buy metal from me. That's not what this is about. It's about trying to convey something that I believe in my soul is happening. We have reached a point where being the world reserve currency, even ask Vice President Vance, who has come out and said so, being the reserve currency is no longer a benefit to the United States. It's a detriment. It's a benefit to us consumers. It's a detriment to anyone who produces anything. And in order to continue to move forward as a country, we need to reshore manufacturing. And the only way to do that is in a devalued dollar and at very low upfront borrowing costs. The Genius Act will keep rates low on the front end of the curve and fund the government. The pegging of gold at a much higher price, regardless if they revalue it or not, which I think they will, I think they'll just let it keep on going higher slowly, and no one notices it, right? No one is taking action because they're waiting for the other shoe to drop, and it always has. Will it continue? I don't know. Gold's up 55% this year. It's on pace for its best year ever. Silver's up almost 70%. And I do think that commodities will now be a reflection of a declining dollar. It's not that the commodities are going parabolic just because. It's because the dollar needs to be devalued in order to reshore manufacturing. And if there's nobility in what President Trump is trying to do, if I'm reading this right, it is the realization that we cannot continue to be the world's superpower without manufacturing anything, with being reliant on the world for everything. And ask yourself this: if the Congressional Budget Office, has come out and said by 2031, 100% of all tax revenue will go just to pay the interest on the debt and mandatory entitlement, how do we continue to fund our military to rule the world when military spending is discretional? Yes, This is all together. Buying gold and silver right now is not, you're not buying it to get wealthy. You're buying it because it is wealth. And the biggest money in the world, the biggest. It's one thing for me to say the central banks are doing it. It's another thing altogether to say the most sophisticated traders on Wall Street, the institutional traders who are standing for delivery left and right, they know what's coming. And I think that's what you follow. We are living in a very tenuous environment. So, yeah, we have a very good supply of product. But again, when you realize that such a small percentage of the public really has any exposure, that can change very quickly. We've been fortunate enough to have the Sprott brokers run all their business through us, where Rick used to be the CEO.
Right.
And one of their brokers, or a few of their brokers, have been placing massive orders over the last several days with us, indicative of smart money, I think, realizing that something is broken and things are changing. So it's not just my brokers, it's not just our business. We work with other people like the brokers at Sprott. And I will tell you that the demand at a level of sophistication that you speak to, the people who you speak to, I would say are far more sophisticated than many of the financial advisors that they would work with mainstream, because they understand the big picture, right? You go to a financial advisor who might be the best in the business, but doesn't acknowledge that the world is the way that all of us think it is. The macro picture, the geopolitical picture, which is so very, very important to understand if that's going to be the backbone of advice that you're given on your portfolio. So I guess all I can simply say to you is that most people are going to be caught off guard by this. And it will go from an environment of high prices that will identify the market to most people, to your people saying, geez, I can't get it easily. It's disappearing. And just like that, it will disappear. So while things are good right now, you get look, let me put it to you this way. Goldman Sachs said, if the market even suspects for a moment that the Fed is losing independence and 5% of the money that's embedded in treasury shifts to gold, the price will go parabolic, will go well north of 5,000. It's going to go well north of 5,000 because Stephen Mirren is the architect of the Mar-a-Lago Accord, and he is now on the Fed. He was Trump's big advisor. Or even this Bo Hines, who was Trump's crypto advisor. He's now running USA Tether, which is backing the Genius Act. There is no independence. The market is going to catch on. The big money is catching on. The rest of the money will too. And then getting product will be very difficult because we've gone a year without any of these wholesalers or refiners or big importers finding much need to go deep into their lines of credit to secure product because there wasn't any need to. I knew there would be. And whether I was stupid or lucky, I'll tell you that there are very few companies out there that have the inventory that we do right now.
If current trends continue, the global financial system may be heading toward a profound reset, one that could redefine the very foundation of trust in money. As physical assets reclaim dominance, a growing divide may emerge between nations and investors who hold tangible wealth and those still dependent on digital or fiat-based systems. The ongoing withdrawal of precious metals from centralized vaults threatens to trigger a broader crisis of confidence in paper markets, forcing major exchanges to confront years of leveraged positions against a shrinking physical supply. Once this reality sinks in, markets could face unprecedented volatility as liquidity dries up and investors scramble to secure assets that truly exist, not just promises on paper. But this transformation isn't only financial, it's deeply psychological. Governments may soon face mounting pressure to back their currencies with real value, while corporations and financial institutions rush to adapt to a world where trust must be earned, not printed. If this evolution accelerates, we may quietly witness the birth of a new monetary order, one grounded not in policy or speculation, but in scarcity, authenticity, and tangible value.